What is up, YouTube, and welcome back to another Fridge Financials video. And in today's video, we are covering what is called the poor man's covered call. So if you're excited for today's video or just curious to know what I'm talking about, feel free as always to like the video, subscribe to the channel, and as always, turn on those notifications for all future uploads. So in today's video, we're going to be breaking down what a poor man's covered call is, how you can do it and take advantage of it, and what you could do for a stock that you are long-term with, but you want some income as you are waiting for it to play out here. So the example that we're going to look at for today is one that is in my portfolio. I'm showing you the charts on Webull just because it looks a lot more clean, and then we'll go over to the Robinhood account afterwards and show you the position and how it works. So what we're looking at is Chipotle Mexican Grill. Now, again, as we might have already seen or heard in the news, again, they recently had their earnings as of July 24th, and they were not what Wall Street was looking for. So you had this big sell-off here as a result. And again, when you're looking at going long in positions, you want to wait till you start to see hopefully a little bit of support and a little bit of a recovery before you start to look at going long again. So Chipotle just sold off on the daily time frame here. And then what you'll notice here is that it hit, this is like a support level looks like for Chipotle, because you've had a little bit of a, bounce back up to the upside as a result. And not only did I do a fib level, obviously, at this level from the recent ones, but there was a previous fib level that I drew that also is from an earlier pullback time, and that fib level also lines up with around the $42 mark. So we did get into calls today at the time of recording this video, and now we're hoping for the upside. But we didn't just get into a call option, we went into a leap option. As we know, leap options are designed to be held for long term and gives the stock a lot of time for it to move before you can become profitable. Because if you trade shorter term expirations, there's more risk because you're looking for a big move in a short amount of time. Whereas with this kind of trade here, it costs a little bit more. We've done videos about leaps. It will cost you more cash up front, but it gives you more time for the stock to play out how you'd want. So for example, with these fib levels here, I'm looking for Chipotle to hopefully start to rally back up closer towards this $50 mark here, about $48 to $49 mark or so. And again, we still have a lot of time for Chipotle to do something here with what the leap option is that I have. So I will show you what we're looking at. So here's the Chipotle stock that you will see here. And we have a $36 call option that expires June 18th of 2026. So basically when school gets out, which is great. And so the idea behind Chipotle here is that, again, you do pay more premium up front here. So again, this option here costed me $1,090. And again, I hate to say it, but I bought it, around like here. And it just seemed like it kind of fell off after that. The market kind of fell off and sold off. So now it is down currently $37. But again, it's a long-term option here. And believe it or not, if you take a look at this option here, my break-even price for this contract is $47 about. Between now and next June, Chipotle needs to hopefully get back above $47. And this at least will be break-even and then profitable anything after that. And as you look at the chart here, again, $47 is right here. So it's not even up to that fib level that we're looking at here. So if it can go up and at least retest the fib level, it'll be a profitable long-term option for me. Now, when you're looking at this, you're saying, well, Fridge, now in the meantime, what can I do here? Because, what happens if it goes against me? I'm down $1,000. Then I'm going to be out $1,000 in my position here. So what you could do in the meantime is do what's called a poor man's covered call. Because remember, when you are buying an option like this here, especially a leap option, when you buy an option, that gives you the right, but not the obligation to take on 100 shares of the stock. This is equivalent to 100 shares of the stock right now. You could either exercise it or you could just sell it off for a profit or loss. Exercise means that I will be able to buy 100 shares of Chipotle at $36 each. Now, obviously, you're like, Fridge, why don't you do that now? Because it's at $43. And the problem is that even though this would cost me, $3,600 here, I would be, even though this cost me $3,600 here if I bought 100 shares right now. And I say, okay, well, Fridge, you're up, $700 right now. It's amazing because that's the case. But remember, I paid $1,090 for it. So I'd be in the hole about $300. So if I closed it now and exercised it, I would be down $300, which we don't want. So, you want to exercise it when it's profitable, and that wouldn't be a profit right now. So what you could do with Chipotle, for example, here is saying, well, in the meantime, Fridge, what can I do? So let's go to view all options here, and we'll kind of walk back through the trade here. So again, I went to June 18th, 2026, again, about a year out here or so. And again, I went down and I bought the $36 call option right here. Now, what you can do in the meantime, because again, there's a lot of time for this stock to move. You're getting a lot of time to do it. But what you could do is you could sell a covered call. But Fridge, I don't have 100 shares of the stock. Yes, you don't have 100 shares of the stock in your brokerage account, but when you buy a call option, it gives you that exposure to 100 shares of Chipotle without paying 100 for 100 shares in cash. So instead of paying $4,300 for Chipotle and then having to sell covered calls, I only pay $1,000 because now I'm restricted on time, but I could still sell covered calls as a result. It's the poor man's covered call, and the name makes sense because instead of paying $4,300 here, I only pay $1,055 here, for example, and then I could still sell covered calls. So I would go to sell a covered call, and I wouldn't do it for the same time here. I would go, a monthly expiration, say, you know what, between now and September 19th, about 30 days out, I think Chipotle won't go above $45 here. So what you'll notice here and what the chart does is it says, hey, you would make some really good profit, a max profit at $45 if between now and September 19th, Chipotle goes to $45. You made $200, $200 on, $1,000 in, option that you bought for the leap is about a 20% return. You can close the position out and you can call it a day. Now, what is happening in this trade here? Okay, so that's the question. Well, there's a lot of different things you can look at here. First one is the easiest one. Chipotle doesn't go to $45 by September 19th. This expires worthless. You still have the leap option, but you just got paid $85 for the month, which is good. Because if you think about it, if I was to do this trade every single time, I did $85 between now and June. So we have September, October, November, December, January, February, March, April, May, June. Yeah, 10 months here to look at for this option here. So 10 months times $85 a month gives you $850 essentially of premium. And you get $850 of premium over those 10 months. If the Chipotle option goes against you, it doesn't work out, okay, well, I just, I'm only down $200 something compared to $1,000 because I've sold covered calls every single month to offset my price paid for the leap option as a result. So as Chipotle doesn't go to 45, cool, I get $85. It offsets my my cost basis, and then I do it again for October, then for November, then December, January, February, so on and so forth. That's the first one. It's the easiest one. The second option is, okay, what happens if it goes to $85? Well, Fridge, how is it that this is happening here? Well, if it goes to $45, the person who bought your sold option here could exercise your shares, and you will be asked to call away your $45 strike of Chipotle shares. But Fridge, I don't have that. I don't have the shares. Remember, we have a call option. Right. So what that means is that you would then exercise your leap option instead at that $36 strike price. Then you would have 100 shares worth, and then you'll use that as your collateral. So instead of having it be the 100 shares at $45, it's going to be your call option that's going to get exercised instead. But think about what's going to happen. If Chipotle stock is rising, as it rises and rises and rises, not only this call option gets closer to my break even of 47 in a quick amount of time, which means the value of this is going to climb. So this value is going to increase. This one is going to decrease. And that's when you get this maximum peak of $45 here. I made $208 profit. Then what would happen? Oh, well, Fridge, when you're getting your shares called away, you don't have the shares. Okay, boom, here's my call option. Exercise that, and that satisfies that condition. And then you close the trade out, and you can move on. Now, if Chipotle goes past $45, notice you're still making profit here. The reason why is because, again, this call option, your leap call option here, is still going deeper and deeper in the money, and it's becoming more and more value. So you still hold a decent amount of value in that leap option because there's so much time still to go with this expiration. and it's already in the break-even point in like a month. Imagine it's break-even in a month. I still have 9 more months of intrinsic value to go with Chipotle running, and I can make even more money as a result. Again, anything past that $47 strike, that $47 break-even is pure profit on my 100 shares of my call option. So if it goes to $48, that thing is a dollar in the money. Then it goes to $50, it's a couple dollars in the money. And again, it's 100 shares of leverage. That's what options are for. They're for leverage. So that's what's happening right here. So, oh no, it went up to $48. I'm still making $160, for example. Now, the thing to remember with a poor man's covered call here is that it limits your upside. Because if Chipotle was to just run without having this covered call option here, the profit would be much greater. But what you're doing is you're trading this long-term profit for a short-term income gain that you're getting here. So you're kind of trading one for the other in this case. But it still can work out very, very nicely because you could also just roll your positions. You could also, roll the strikes higher, roll to a further date if you want to. You could just close this early if you think it's going to have a big run up here. There's a lot of different things that you could do as a result. But the good thing is that say Chipotle doesn't make as much of a move as fast as you're hoping, at least you'll be able to offset some of their cost basis here. And that's what's important. Because again, if I could trade this contract here every month for 10 months, oh wow, look at that. I just basically lost only $200 on the trade that I held for a year. It's still a loss, but it's not as bad. If I wanted to be more aggressive, I want to do $44.50 strikes. This is $1,000 if I did it over 10-month increments, $100 every single month. That basically means that this leap option is going to basically break even at $0 here, essentially, if Chipotle doesn't do much between now and June of next year. So a poor man's cover call is a good way to get income in the short term. But again, the downside is your future value. If Chipotle runs to $50 and it squeezes up super high for some reason in the next month, I'm still forced to exercise this at $44.50. I'm missing out on that $5.50 upside gain on my leap option, which obviously sucks. But again, if I can sit there and I can make say I wanted to do a $46 strike here potentially. If I get exercise at $46, I would make $260 on $1,000 in a month. That's a 26% gain in a month. Oh no, I got to exercise for 26% profit. Yes, I missed out on more capital gains in the future. But still, 26% a month is absolutely amazing. So if you are ever looking at buying leap options and you know it's going to take some time, which it will for Chipotle, for example, for my leap option to play out, hopefully, if it's going to take time, you could always sell covered calls in the meantime just to, get some passive income as you go, And if you want to go super, super safe, pick a delta that's super low, and also do it on a green day. You don't want to do it on a red day. So I didn't do it on a red day because Chipotle is down 1% for the day. So I would do it if Chipotle was up 1 or 2% on the day. I would say, okay, maybe I'll sell, a $47 call option here. 20% delta here, I would get $38 and it's less likely to be assigned. And if it does go to $47 in the month, I'm making over $300 in profit because that leap option is becoming very, very valuable. So this is how a poor man's cover call works. Right also here is like a possible diagonal. Essentially, you could do different ways of doing different strategies here. Diagonals are a little bit different in this case though, but the best way to do this, though, when you're doing a leap option is to buy a leap option that is in the money. Because what happens is that this option is moving almost 1-to-1 with Chipotle stock. It gives you that exposure to almost exactly like that 100 share movement of the share price without having to buy 100 shares worth. The delta being 78 means that for every dollar Chipotle moves, this contract moves 78 cents worth. The higher the delta, the more it moves with the stock. So that's something to keep in mind about because as the stock is moving up, that means your leap option has more movement with it. And that's something to keep in mind about when you're doing these kind of poor man's cover calls. And it does really help. But again, it makes your break even a lot less. Instead of doing like an out of the money one, like out here, like $52, your break even's at $54, $54.75 here. And if you look at your charts, $54.75, you have to break through this little level here, which I feel like might be some resistance here. You have to break through here and go to the next level here. could be tough for Chipotle. You don't really know, obviously, with how stocks move these days, right? So that is how a poor man's covered call essentially works. So again, if you do have any kind of leap options and you don't mind offsetting a little bit of your capital gains with selling a covered call here to get some income for it. Again, it does give you a little bit of downside protection, which to me is what I want, especially in these kind of markets. You don't know what's going to happen between now, next month, couple months out. So with leap options, it gives you a little bit of that extra leverage and a little bit of extra support, and it de-risks a little bit because you can offset your leap option with a covered call here, essentially. So it's a way to hedge your portfolio in that case. So thank you guys so much for watching today's video. If you did make it this far in the video, as per usual, and you learned something new, feel free to smash the like button, subscribe to the channel, turn on the notifications as per usual. I hope you're making money in the market in some way, shape, or form. And as always, guys, I will see you in the next video.